Hey everyone, welcome back to our channel. Today, we're diving into the fascinating world of cryptocurrency exchanges. If you've ever wondered what they are, how they work, and why they're so important in the crypto ecosystem, you've come to the right place. So, let's get started. All right, first things first. What exactly is a cryptocurrency exchange? In simple terms, a cryptocurrency exchange is a platform that allows you to buy, sell, and trade various cryptocurrencies. Think of it like a stock market, but for digital currencies. There are two main types of exchanges: centralized exchanges, or CEXs, and decentralized exchanges, DEXs. Centralized exchanges, like Coinbase and Binance, are operated by companies that facilitate transactions between buyers and sellers. They offer user-friendly interfaces, customer support, and often a wide range of trading pairs. However, they also require you to trust them with your funds. On the other hand, decentralized exchanges operate without a central authority. This means you can trade directly from your crypto wallet without needing to deposit your funds into the exchange. Examples include Uniswap and SushiSwap. DEX provide greater privacy and control over your assets, but they can be more complex to use, especially for beginners. Now that we know what exchanges are, let's explore how they actually work. When you want to buy or sell cryptocurrency, you place an order on the exchange. There are two main types of orders: market orders and limit orders. A market order is the simplest type of order. When you place a market order, you're instructing the exchange to buy or sell a specific amount of cryptocurrency at the current market price. This means your order will be executed immediately, but you may not get the exact price you were hoping for, especially in a volatile market. On the other hand, a limit order allows you to set a specific price at which you want to buy or sell. For example, if you want to buy Bitcoin, but only at $30,000, you can place a limit order at that price. Your order will remain open until the market reaches your specified price, at which point it will be executed. This gives you more control over the price at which you trade, but there's always the risk that your order may not be filled if the market doesn't reach your limit. Now, let's talk about order books. Both centralized and decentralized exchanges use order books to match buyers and sellers. An order book is a list of all the buy and sell orders in the market, organized by price. When you place an order, it gets added to the order book, and the exchange matches it with other orders that have compatible prices. In a centralized exchange, the platform itself maintains the order book and facilitates the transaction, while in a decentralized exchange, smart contracts handle the order matching and execution, allowing for a more trustless and transparent process. Liquidity is another key concept when it comes to exchanges. It refers to how easily you can buy or sell an asset without affecting its price. Centralized exchanges tend to have higher liquidity due to the large number of users and trading volume, which means you can quickly execute your trades at stable prices. Conversely, decentralized exchanges often have lower liquidity, especially for less popular trading pairs. This can lead to slippage, where the price at which you execute a trade differs from the expected price due to insufficient buy or sell orders at your desired price level. As you can see in this chart, centralized exchanges typically have a depth of orders that allows for quick execution. This is why many traders prefer them for larger transactions. However, decentralized exchanges are gaining traction as they offer greater control over your assets and enhanced privacy.
Tired of complicating your life with traditional payments? With Bitrefill, your cryptocurrency becomes the key to simplifying every purchase. Use Bitcoin and other cryptocurrencies to pay anywhere, quickly and securely, from your daily shopping to gifts for the people you love. Bitrefill is your pass to a world without borders. Instant payments, zero stress. Safe, fast, everywhere. What are you waiting for? Join millions of users who have already revolutionized the way they pay.
Now, let's discuss the types of market orders you can place in an order book. The two most common types are market orders and limit orders. A market order is executed immediately at the current market price, providing quick entry or exit, but with potential slippage. On the other hand, a limit order allows you to specify the price at which you want to buy or sell. This means your order will only be executed if the market reaches your desired price, offering more control, but with the risk that your order may not be filled if the market doesn't move in your favor. Many traders use a combination of both order types to optimize their trading strategy. For example, a trader might place a market order for a quick entry and a limit order to take profits at a higher price. Understanding how to navigate the order book effectively can significantly enhance your trading performance. Market depth is another important aspect of order books. It refers to the number of buy and sell orders at various price levels. A deeper market depth indicates a more stable price, as there are more orders available to absorb larger trades. Traders often analyze market depth to gauge the potential price movement and to determine the best entry and exit points. In this example, you can see how many orders are lined up at different price points. A robust market depth means that even if a large order is executed, the price is unlikely to move significantly. This is particularly important for institutional traders or anyone looking to make large trades. In summary, understanding order books, liquidity, types of orders, and market depth are crucial for anyone looking to trade effectively on both centralized and decentralized exchanges. By mastering these concepts, you can make more informed trading decisions and optimize your strategies for better outcomes. Thank you for joining us today, and happy trading. Contrast, decentralized exchanges may experience lower liquidity, especially for less popular tokens. This can lead to slippage, where the price you receive for your trade is different from the price you expected. In summary, while both centralized and decentralized exchanges provide platforms for trading cryptocurrencies, they operate in fundamentally different ways. Centralized exchanges offer ease of use and high liquidity, but require a degree of trust in the platform. Decentralized exchanges prioritize user control and privacy, but come with their own set of complexities. So, how do you choose the right exchange for your needs? That's what we'll cover in our next segment. A market order is executed immediately at the current market price. It's the quickest way to buy or sell, but you might not get the best price if the market is volatile. A limit order, on the other hand, allows you to specify the price at which you want to buy or sell. This means you can wait for the market to reach your desired price, but it could take longer to execute. Once your order is placed, the exchange matches it with another user's order. If you're buying, your order is matched with someone who wants to sell, and vice versa. The exchange facilitates this transaction and takes a small fee for their services, which can vary from one platform to another. So, why are these exchanges so crucial for the crypto ecosystem? Well, they serve as the gateway for most people entering the world of cryptocurrency. Without exchanges, it would be incredibly difficult for individuals to convert their fiat money, like dollars or euros, into cryptocurrencies. Exchanges also provide liquidity to the market, which is essential for price stability. The higher the volume of trades on an exchange, the less likely it is for prices to fluctuate wildly. Additionally, they play a critical role in price discovery, as they aggregate buy and sell orders from users around the world, helping to establish the market value of various cryptocurrencies. If you're thinking about getting into crypto trading, here are a few tips for choosing the right exchange. 1. Security. Look for exchanges with strong security measures, such as two-factor authentication and cold storage for funds. 2. Fees. Compare trading fees, withdrawal fees, and any other costs associated with using the exchange. 3. User experience. Choose an exchange that has a user-friendly interface and provides good customer support. 4. Available cryptocurrencies. Make sure the exchange offers the cryptocurrencies you're interested in trading. In conclusion, cryptocurrency exchanges are vital to the crypto landscape, making it easier for people to buy, sell, and trade digital assets. Whether you choose a centralized or decentralized exchange, understanding how they work will help you navigate the crypto world more effectively. If you found this video helpful, don't forget to hit that like button and subscribe for more content on cryptocurrency and investing. And drop your questions or thoughts in the comments below. We love hearing from you. Until next time, happy trading. If you haven't already done so, visit our website. You will find the link in the description.